Warren Buffett, known as the Oracle of Omaha, is revered as one of the greatest investors of all time. His principles and rules for investing have not only guided his own remarkable success, but have also served as a beacon for countless individuals seeking financial prosperity. In this video, we will delve into Warren Buffett's 10 principles and rules for investing, exploring their significance and practical application in crafting a successful investment strategy. Principle 1. Never lose money. During the 2008 financial crisis, Buffett's adherence to this principle was evident in his investment strategy, particularly with Bank of America. In 2011, as the banking sector faced turmoil, Buffett's Berkshire Hathaway injected $5 billion into Bank of America. Despite concerns over the bank's stability, Buffett recognized its enduring value and importance to the financial system. Buffett's investment not only provided crucial capital during the crisis, but also positioned Berkshire to benefit from Bank of America's eventual recovery. This example showcases Buffett's commitment to capital preservation amidst uncertainty, ultimately leading to significant returns for Berkshire shareholders. Remember, prioritizing capital preservation, as Buffett does, can help navigate market volatility and achieve long-term success in investing. Principle 2. Only invest in what you understand. This principle underscores Buffett's belief in thoroughly comprehending the businesses he invests in, a philosophy that he has consistently applied throughout his career. While tech stocks soared, Buffett refrained from investing, instead focusing on businesses he understood deeply. One such investment was See's Candies, a company with a straightforward business model that Buffett could easily grasp. By adhering to this principle, Buffett avoided the pitfalls of the dot-com bubble and focused on businesses with enduring competitive advantages. Principle 3. Be fearful when others are greedy, and greedy when others are fearful. This principle highlights Buffett's contrarian approach to investing, where he seeks opportunities during market pessimism and exercises caution during times of exuberance. One notable example of this principle in action is Buffett's investment in Goldman Sachs during the 2008 financial crisis. As panic gripped the financial markets and fear reached its peak, Buffett saw an opportunity to capitalize on the market's pessimism. In September 2008, Buffett's Berkshire Hathaway invested $5 billion in Goldman Sachs through preferred stock and received warrants to purchase additional shares at a predetermined price. As the financial crisis subsided and confidence returned to the markets, Goldman Sachs' stock price rebounded, resulting in significant gains for Berkshire Hathaway. This example illustrates Buffett's ability to remain rational and opportunistic during periods of market turmoil, ultimately leading to profitable outcomes for his investments. Principle 4. Invest for the long term. This principle lies at the core of Warren Buffett's investment philosophy, emphasizing patience and a focus on the intrinsic value of businesses. Warren Buffett's dedication to this principle is exemplified by his ownership of Berkshire Hathaway. Buffett has held on to Berkshire shares for decades, allowing the company's value to steadily compound over time. By maintaining a long-term perspective, Buffett has navigated market fluctuations and capitalized on sustained growth. So, the next time you're considering an investment, remember Buffett's advice: focus on the long term and invest in businesses with enduring value. Principle 5. Price is what you pay, value is what you get. This principle underscores Warren Buffett's focus on the intrinsic value of investments rather than their current market price. An excellent example of this principle in action is Buffett's investment in American Express in the early 1960s. At that time, American Express faced a significant setback due to a scandal involving unauthorized charges. As a result, its stock price plummeted. However, Buffett saw beyond the temporary setback and recognized the enduring value of American Express's brand and customer loyalty. He understood that the company's intrinsic value was far greater than its depressed market price. Buffett's investment in American Express proved to be highly lucrative as the company recovered from the scandal, and its stock price soared over the years. Principle 6. Diversification is protection against ignorance. Warren Buffett's approach to diversification emphasizes quality over quantity, focusing on a concentrated portfolio of high-quality businesses he thoroughly understands. One striking example of this principle in action is Buffett's investment in Coca-Cola. Despite the temptation to diversify across numerous industries, Buffett concentrated a significant portion of his portfolio in Coca-Cola stock. Buffett's rationale was simple. Coca-Cola possessed enduring brand power, global distribution networks, and a consistent track record of profitability. By focusing his investments on a handful of high-quality companies like Coca-Cola, Buffett was able to mitigate risk while maximizing long-term returns. Over the years, Coca-Cola has delivered consistent returns for Berkshire Hathaway shareholders, validating Buffett's strategy of concentrated investing. So, when building your investment portfolio, remember to prioritize quality over quantity, just as Warren Buffett does. Principle 7. Margin of safety. This principle underscores Warren Buffett's focus on minimizing risk and protecting capital by investing in assets with a significant margin of safety. When Buffett began acquiring shares of Coca-Cola in the late 1980s, he sought to ensure a substantial margin of safety in his investment. Despite Coca-Cola's status as a well-established and profitable company, Buffett insisted on buying the stock at prices significantly below his estimate of its intrinsic value. Over the years, Coca-Cola's stock price has appreciated, delivering substantial returns for Berkshire Hathaway shareholders. This example illustrates Buffett's disciplined approach to investing, emphasizing the importance of buying assets at prices that provide a margin of safety. Principle 8. Invest in management with integrity and talent. Buffett emphasizes the importance of investing in companies led by trustworthy and capable management teams who prioritize shareholder interests and demonstrate sound business judgment. One notable example is Buffett's investment in Apple Inc. Under the leadership of CEO Tim Cook, Apple has continued to innovate and deliver products that resonate with consumers worldwide. Buffett's confidence in Apple's management team, combined with the company's strong brand and loyal customer base, has made it one of Berkshire Hathaway's largest holdings and a significant contributor to its investment returns. By investing in companies with talented and ethical leadership, Buffett ensures that his capital is deployed effectively and ethically, maximizing long-term value for shareholders. Principle 9. Invest in businesses with enduring competitive advantages. Buffett seeks companies with strong economic moats or competitive advantages that protect them from competitors and enable them to maintain profitability over the long term. An excellent example is Buffett's investment in the Walt Disney Company. Despite market fluctuations and changes in consumer preferences, Disney's strong brand, diversified revenue streams, and valuable intellectual property have allowed it to weather industry challenges and deliver consistent returns to shareholders. By investing in Disney, Buffett capitalized on the company's enduring competitive advantages and its ability to adapt to evolving market conditions. Principle 10. Be patient and disciplined. Warren Buffett emphasizes the importance of patience and discipline in successful investing. Buffett once said, "The stock market is designed to transfer money from the active to the patient." This quote underscores his belief in the power of patience when it comes to investing. In essence, Buffett advises investors to resist the urge to constantly buy and sell based on short-term market movements. Instead, he advocates for a disciplined approach, focusing on the long-term fundamentals of businesses. In conclusion, Warren Buffett's 10 principles and rules for investing offer valuable insights for investors seeking long-term success in the stock market. By incorporating these principles into your investment strategy, you can establish a solid foundation and increase your chances of achieving financial freedom.